This is a drilling rig. Specifically, it's the Arcticheskaya platform, photographed by commercial satellite on January 14, 2026, operating in the Kara Sea, approximately 340 kilometers north of the Russian mainland. The platform is drilling in water temperatures of -2 degrees Celsius through 80 meters of seabed into a formation that Gazprom estimates contains 1.2 trillion cubic meters of natural gas. The operation costs approximately $47 million per month. The extracted gas will travel 2,400 kilometers through pipelines not yet built to liquefaction facilities not yet completed, serving customers who have not yet signed contracts. This is supposed to be Russia's energy future, the Arctic bonanza that will replace European markets, fund the war machine indefinitely, and prove that Western sanctions cannot constrain Russian power. Here's the problem. The numbers don't work. And on January 18, 2026, those numbers started becoming visible in ways that Moscow has spent 3 years trying to obscure. At 9 a.m. Moscow time, Gazprom published its annual report. 3 months late, a delay attributed to audit complexity, but widely understood as reluctance to reveal deteriorating financials. The report showed something that Russian state media did not mention. Arctic development costs have exceeded projections by 67%. Production timelines have slipped by 24 to 36 months. And the customers who were supposed to replace Europe are negotiating prices that make many projects economically unviable. Russia's Arctic gas push isn't a masterstroke. It's a massive bet that is already showing signs of failure. And Europe's energy strategy, for all its flaws, may outlast it. Here's what they're not telling you. The Arctic looks like Russia's salvation on a resource map. The region contains an estimated 412 trillion cubic feet of natural gas, enough to supply current global demand for 12 years. Russia controls approximately 70% of this resource through territorial claims and continental shelf extensions. If even a fraction of this gas reaches markets, the thinking goes, Russia becomes the indispensable energy supplier for the century. The resource map ignores the cost map. Arctic gas extraction operates under conditions that multiply every expense. Temperature. Equipment designed for temperate operations fails in sustained -40-degree conditions. Specialized Arctic-rated machinery costs 3 to 4 times more than standard equipment. Maintenance cycles shorten from annual to quarterly. Worker productivity drops 40% due to limited daylight, extreme weather, and the physiological stress of operating in polar conditions. Distance. The Yamal Peninsula is 2,400 kilometers from the nearest major industrial center. Every piece of equipment, every worker, every supply shipment must travel distances that add cost at every stage. A compressor that costs $2 million delivered to a Texas gas field costs $7 million delivered to Yamal. Infrastructure. Arctic operations require not just drilling equipment, but entire support ecosystems. Housing for workers, power generation for facilities, transportation networks across terrain that is frozen tundra for 8 months and impassable swamp for 4. The infrastructure investment required before a single molecule of gas flows exceeds $20 billion per major project. Russia has committed to this investment based on assumptions that are proving incorrect, that Asian customers would pay European prices, that Western technology could be easily replaced, and that project timelines would hold despite sanctions pressure. At 4:30 p.m. Beijing time on January 12, 2026, China National Petroleum Corporation concluded a pricing negotiation with Gazprom that has not been publicly disclosed, but whose terms have leaked through industry channels. The agreed price for Power of Siberia 2 gas, the flagship Arctic to China corridor, is indexed at 15 to 18% below European spot market equivalents. At current prices, this represents approximately $2.50 per million BTU, less than Gazprom projected when approving the project. At that price, Power of Siberia 2 generates returns below Russia's cost of capital. The project will operate at an economic loss for its first decade, a loss that Russian state budgets must absorb. This is where the lie becomes unsustainable. Russia's Arctic economics depend on price assumptions that have not materialized and volume assumptions that face growing constraints. The price assumption was that Asian buyers, desperate for energy security, would pay premiums to secure Russian supply. The reality is the opposite. Asian buyers recognized Russia's desperation to replace European markets and negotiated accordingly. China is not paying European prices. China is paying prices that reflect Russia's lack of alternatives. India has negotiated even steeper discounts. The pivot to Asia has become a fire sale. The volume assumption was that production would ramp according to schedule, generating cash flow that funds continued development. but sanctions have disrupted the equipment supply chain in ways that Russia has not fully overcome. Arctic LNG 2, the facility that was supposed to demonstrate Russia's ability to build major projects without Western technology, has experienced a 34% capacity shortfall in its first year of operation. The liquefaction trains, assembled in Russia after Chinese fabrication, do not achieve design efficiency. The compressors, sourced from domestic suppliers after Siemens withdrew, require 23% more energy input per unit of output. The ice-class tankers, ordered from Chinese shipyards after Korean yards refused delivery, have experienced mechanical issues that have idled 3 of the initial 7 vessels. On January 16, 2026, the Russian Ministry of Energy quietly revised its 2030 Arctic production forecast from 180 billion cubic meters to 142 billion cubic meters, a 21% reduction attributed to infrastructure scheduling adjustments. The revision was not announced. It appeared in an appendix to a regulatory filing that few observers monitor. The revised number still exceeds current production by a wide margin, but it represents a trajectory that will not achieve the scale Russia needs to offset lost European revenue within the time frame that matters for war financing. When institutions do this, they're not managing risk, they're containing disaster. The financial strain of Arctic development is becoming visible in Russian fiscal data that the government has stopped publishing in detail. Russia's National Wealth Fund, the sovereign reserve intended to buffer budget shortfalls, has declined from $186 billion in January 2022 to an estimated $54 billion in January 2026. The drawdown has funded military operations, covered budget deficits, and subsidized energy projects whose revenues have not materialized as projected. At current depletion rates, the fund will be exhausted by late 2027. The federal budget for 2026 projects oil and gas revenue of $192 billion. This projection assumes oil prices of $70 per barrel and gas prices of $350 per thousand cubic meters, both above current market levels. If prices average 15% below assumptions, the resulting shortfall would be approximately $29 billion, more than half the remaining wealth fund. Arctic development competes for capital with military spending, social programs, and infrastructure maintenance. Every ruble invested in Kara Sea drilling is a ruble not invested in tank production, pension payments, or road repair. The opportunity cost is becoming politically visible as regions outside Moscow experience service degradation that federal budgets cannot address. On January 19, 2026, the governor of Novosibirsk Oblast, Russia's third largest region by population, gave an interview in which he described unprecedented fiscal challenges, requiring difficult choices between investment priorities. The interview was removed from the publication's website within hours. The removal suggests that fiscal constraints have become sensitive enough that even oblique references trigger suppression. Less than 18 months remain before the National Wealth Fund's projected exhaustion. Within that window, Arctic projects must either begin generating positive cash flow or face funding constraints that delay completion further. The timeline creates a vicious cycle. Delays increase costs. Increased costs require more funding. Funding constraints cause additional delays. While one side struggles, the other side adapts. Europe's energy strategy is not succeeding as designed, but it is succeeding in ways that matter against Russian Arctic ambitions. The demand reduction that Europe achieved through conservation, efficiency, and industrial adjustment has persisted longer than analysts expected. European gas consumption in 2025 was 340 billion cubic meters, down from 412 billion cubic meters in 2021. The reduction was supposed to be temporary, a crisis response that would reverse when supply normalized. Instead, it has become structural, as industrial processes have been redesigned, heating systems have been replaced, and consumption patterns have shifted. Every cubic meter of demand that Europe permanently eliminates is a cubic meter that Russian Arctic production cannot sell at any price. The market that Russia is building Arctic infrastructure to serve is shrinking while the infrastructure is being built. At 11 a.m. Amsterdam time on January 17, 2026, Shell announced that its European gas trading division would reduce contracted supply volumes by 15% over the next 3 years, citing structural demand decline that makes current contract levels uneconomical. Similar announcements from BP, Total Energies, and Equinor have followed. The major traders are repositioning for a European market that is smaller than the one they planned for. The renewable build-out continues, behind schedule but still advancing. Europe added 62 gigawatts of renewable capacity in 2025, the second largest annual increase in history. The additions are concentrated in solar, which provides maximum generation during summer months when gas demand is lowest. But storage deployments are accelerating, and grid infrastructure is expanding. Each gigawatt of renewable capacity that comes online is a gigawatt that doesn't require gas backup as frequently. The LNG infrastructure that Europe built as a crisis response has created optionality that didn't exist before 2022. European regasification capacity now exceeds 220 billion cubic meters annually, more than enough to replace all Russian supply and then some. The capacity provides negotiating leverage against any single supplier, including Russia. Europe can say no to unfavorable terms because alternatives physically exist. The combination, reduced demand, growing renewables, expanded import options, creates a European energy position that is worse than before the crisis, but better than Russia's Arctic economics require. Russia's Arctic bet assumed a Europe that would eventually return to Russian gas out of desperation. Europe has instead built a system that can survive indefinitely without Russian supply, even if that survival is more expensive than the pre-crisis status quo. The mathematics of the trap are now working against Russia. Russia faces a configuration where Arctic economics and war economics are increasingly incompatible. Arctic development requires patient capital. Projects take 7 to 10 years to reach full production. Returns materialize over 20 to 30-year horizons. The investment logic requires stability, predictable costs, reliable customers, and financing terms that allow long-duration payback. War requires immediate capital. Military operations consume resources as they're spent. Equipment destroyed today must be replaced tomorrow. Personnel costs and ammunition production scale with conflict intensity, not with revenue cycles. The spending logic requires liquidity, cash available now, regardless of future returns. The National Wealth Fund has mediated between these competing demands, but the fund is nearly depleted. What follows is direct competition. Every dollar spent on Arctic infrastructure is a dollar not available for military operations, and every dollar spent on military operations is a dollar not available for Arctic infrastructure. On January 14, 2026, the Russian government announced a 23% increase in military spending for the 2026-2028 budget cycle, bringing defense expenditure to $145 billion annually. The announcement did not explain how the increase would be funded. Subsequent analysis by the Vienna Institute for International Economic Studies suggested that the increase requires either deficit financing at levels that risk inflation acceleration or reallocation from capital investment programs, including Arctic development. The strategic choice is becoming binary. Russia can fund the war at levels required to continue current operations, or Russia can fund Arctic development at levels required to meet production targets. It cannot fully fund both. Europe's strategy doesn't need to succeed perfectly. It needs to succeed long enough that Russia's competing priorities force choices that constrain Arctic expansion. That timeline, 18 to 24 months until resource constraints become acute, is shorter than the timeline for Arctic projects to reach self-sustaining cash generation. This is what a system looks like when the race is closer than one side wants to admit. The informed are not waiting for official announcements to understand what's happening. Gazprom's stock price has declined 62% from its pre-war peak, despite record revenues in 2022 and continued production volumes. The decline reflects investor assessment that future cash flows will not materialize as projected, that Arctic costs will exceed revenues, that Asian prices will remain below European benchmarks, and that the company's strategic position has permanently deteriorated. Russian sovereign bond yields have risen to 14.2%, the highest since the 1998 default crisis, reflecting market assessment that fiscal sustainability is increasingly uncertain. The yield premium over comparable emerging market debt has widened to 650 basis points, indicating that credit markets view Russia as significantly riskier than official statistics suggest. Ruble exchange rates have shown increasing volatility despite central bank intervention, with weekly swings exceeding 5% becoming common. The volatility reflects capital flows responding to fiscal uncertainty that fixed exchange rate mechanisms cannot fully contain. Chinese investment in Russian energy projects has declined 34% from 2023 levels, according to tracking by the American Enterprise Institute. The decline suggests that China has concluded that maximum investment has been reached, that additional exposure to Russian project risk is not justified by potential returns. The partner that Russia depends on most is pulling back. Physical gold flows from Russia to China have increased 180% year over year, suggesting that Russia is converting energy revenue to hard assets rather than reinvesting in production capacity. The flows indicate a shift from expansion strategy to preservation strategy, protecting existing wealth rather than building new capacity. The spread between Russian Arctic project costs and comparable non-Russian projects has widened to 45%, reflecting the sanctions-induced efficiency losses that Russian operations cannot overcome. The spread makes Russian Arctic gas structurally uncompetitive against alternatives that face none of the same constraints. The question is not whether Russia's Arctic push will succeed. The question is whether it will succeed before the constraints overwhelm the ambitions. And the evidence increasingly suggests it will not. A drilling rig in the Kara Sea, -2-degree water, 80 meters of seabed, $47 million per month. A bet that assumes customers who are negotiating discounts, technology that isn't performing, and timelines that keep slipping. This is not an energy empire. This is an energy gamble, a massive commitment of resources to a future that may not arrive before the resources run out. Physics doesn't negotiate. Arctic economics don't bend to political will, and reality, eventually, asserts itself over every strategy that assumed scale would overcome cost. The divergence between Russia's Arctic ambitions and Russia's Arctic capabilities is becoming measurable. What happens next is not prediction. It's 67% cost overruns, 34% capacity shortfalls, and a national wealth fund with 18 months of runway remaining. Europe doesn't need to win the energy race. Europe just needs to not lose before Russia's bet fails. And that outcome is looking more possible than Moscow wants to admit.